All right, everyone, welcome back to Empire. We've got the macro greats. We've got Quinn and Felix from the Forward Guidance Pod, also Blockworks Pod. Hopefully, you guys know that. Felix, Quinn, welcome to the show.
Thanks for having us. Happy Friday.
Super excited to be here finally. What's going on, guys?
Yeah, Quinn, you're in like every conversation now that I hear people talking about the markets. And Felix, I feel like I see you on every podcast now. I saw you on the chopping block. I see you everywhere now.
It's been a big week. I was on, this is my fourth podcast this week, and I said no to two others too because I was just like, I'm running out of things to say, but want to keep them prioritized for the Blockworks pod. So yeah,
it's a big bottom signal for markets probably, and a top signal for us.
It is when the crypto people are listening to a bunch of macro stuff. When Empire is bringing some macro guys on the show, that's a bottom signal. It actually is a decent signal. But anyway, I think I wanted to have you guys on. So we're recording this on Friday, April 11th. This is going to go live on Monday. Quinn, I thought it'd be helpful to just actually take us back to either November or the beginning of the year. If people think back to then, everybody, including myself, was like 2025 is the year. This is the bull market, ripper of a year. Like, all systems go. And I think you came into the year, we had record high asset prices and you had just turned bearish. And I was like, look, I like Quinn. I don't know what this guy's talking. Why are we bearish? Doesn't he know that we just elected, the bull market president? And I think that you were one of the only people who really nailed that call. So I'd love for you to just take us back to the beginning of the year. Like, what caused you to turn bearish back then?
Yeah, it was so starting at the election or around the election, we were in the midst of aggressive Fed rate cuts that at this point kind of generally accepted we didn't need at least the extent of which we got 100 basis points last fall in consecutive meetings. And that powered asset prices because it drove liquidity in the markets. And obviously we were screaming to all-time highs into late December and start of this year. And on top of that, you had the Trump election, which really set off everybody's recollection to 2016, and 2017 was the lowest volatility year ever for the S&P 500 up to that point, and some really strong return years. But what I think people missed was the starting point of valuations in the market and where we were beginning this sort of liftoff from was extremely elevated already, thanks to a lot of the liquidity mechanics and we did have a fairly strong earnings growth across corporates, but a lot of this was being driven by unsustainable government spending, liquidity facilities that the Fed was basically winding down or had already drained. And so a lot of these big tailwinds under the surface were coming to an end. And then it became sort of pairing that with the policy initiatives, which the Trump admin was quite clear about. I think people were sort of looking past the actual ramifications of what these things were going to do, and cutting deficits, Doge, but also the budget reconciliation is likely to even cut more than Doge will. And then the reorientation of trade policy and cutting immigration through the southern border to almost zero overnight. So a lot of growth negative changes being enacted early on. And I think what most in the market missed was the cadencing of the policy initiatives, which I do think there will be some good years of Trump's presidency when it comes to asset returns. But thus far, all of those pro-growth, pro-business, positive market things have been put in the back pocket to sort of pain before pleasure type of idea. So that's the general overview. And I think as the market sort of realized this over the last 3 months, you had a number of, just big sellers deleveraging their books.
Mm-hmm. Yeah, it's funny. I had a similar conclusion, but came to it through different factors that drove that analysis for me. So mid-December, late December, I started to be a bit concerned about a growth slowdown emerging at a point where the Fed decided they went pretty hawkish in mid-December and took this tilt where they wanted to just sit on their hands and basically be intentionally complacent and slow to react, which is the complete opposite situation of where they were in August and September, where they wanted to get ahead of the labor market, which was starting to see some deterioration. So they flipped their their perspective entirely from going from proactive to entirely reactive intentionally and be as slow to react as possible. So that paired with what I was seeing in the economy was that the economy was actually already starting to slow down. There's some really interesting factors if you look at, so, if you just rewind to COVID era level spending, all that fiscal spending, it actually ended up in the treasuries of state and local governments for them to spend up. And that is one of the big reasons why we've seen like so much government hiring in the past couple of years in the labor market, is they had so much money that they just had to spend and on their book. And effectively, the cliff of all that spending of when it would run dry was going to be around January 2025. So that was one of the biggest drivers of this like fiscal induced growth that Quinn was just referring to. And that was coming to end regardless of what was going to go on. So that's happening. There's some other cross currents really deep in the weeds of the economy that look like they're starting to deteriorate. So if that's coming down, and then you have the Fed that's just deciding to not follow it down and just remain flat, that creates this tension. And then you bring in the expectations of euphoria, especially in the crypto market, in terms of, we're pricing in like an all-out strategic Bitcoin reserve. We're pricing in them, hitting the market and just buying and TWAPing into heaven. So that created a lot of these tension points where it's like, I'm not really liking what I'm seeing here in terms of what's expected in the market versus some of the points of reality. And even if I'm not correct on that, it's still like, how do we get better in terms of expectations that we have priced here? So that's what got me concerned. It wasn't even really specific to all that much in terms of Trump policy. And obviously that's accelerated things since.
The historical data shows that like after 2 or 3 years of really strong annual returns, the market, there's just a reversion of the mean. And this is a classic. It's not what you believe. It's like what is already priced in. Because you could look at, this is Howard Marks, like put out a great tweet and shall retweet it, just like, it's just what is the expectations that's been built. And I think that's what most people in crypto miss. That's what most people in traditional markets miss. It's like, yeah, it's great. We have a pro crypto administration, but you have to look at simplistically what's M2, what's the general market going to do? Like this is still a risk asset. And you take a perhaps a more different perspective that I think a lot of people in crypto didn't appreciate, and also in traditional markets as well, which is it's sort of a reversion of the mean, so to speak, because it's when things are priced to perfection, it doesn't take much to derail markets. Of course, we've had far more than just a hiccup with a trade war, which we want to go to talk about perhaps next. But how do you guys, as managers, like factor all that in? How quickly do you respond to new information? Of course, a lot of things have transpired the last couple of weeks, but going into the year, like maybe take us back to January. Like, how are you repositioning the portfolio? I'm kind of curious how quickly you respond to information and move your portfolio around.
Just to give people a context of how elevated we were in terms of risk asset valuations, the equity market forward price to earnings ratio was at 2021 highs. So like peak, like big time stimulus liquidity expectations. And on top of that number, the forward earnings estimate was year over year growth expected to match basically the last time Trump was in office when he enacted those huge, massive tax cuts. So we're talking like incredibly high multiples on top of incredibly high expectations. So there was just a ton of room if the plane did run out of jet fuel to sort of re-rate lower to a more normal steady state. So for us, these things take a long time to form. I mean, we could even still be in a massive, 6-month topping process across risk assets. That's definitely not out of the potential, outcome probability distribution, but they take long. So, coming into the year, we were very patient and just taking very small, high risk reward shots on goal, I'd say, on buying massive sell-offs for some reversion and even taking some things from the short side or pair trades like short ETH, long BTC type of things. But yeah, I do think we're due for some reversion back up, but it's still unclear to me that it's off to the races from here, but we'll see.
Yeah, Santi, I mean, what you bring up, I think, is why it's so important for just the everyday person to understand the time horizon that they're operating on. And you guys, like Yano and Santi, you guys both do such a great job of really hitting the nail on the head that, like, if you're an investor, act like one and don't try to shift your time horizon in the heat of the moment just because VIX is at 50. So yeah, going into these big events, you need to understand what part of your book are you trading, what part of it are you investing, and when you're allocating, are you allocating for a 1 day flip, a 2 week hold, a multi-month swing, or are you just completely tuning it out? Because that reflects on how you operate through this. Because you can take a more trader lens where it's like, okay, I see Liberation Day, like, as soon as that chart hit, because at first going into it, I was like, oh, okay, only 10%. And then 2 minutes later, it's like, okay, that's actually like way, 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 way high, like a 30% effective tariff rate. So as soon as that hits, you have to decide, how do you operate through that? If you're like a long only investor, do you just weather the storm? Or do you decide to override it in terms of, okay, I'm just going to buy some downside hedges? Or do are you just a pure trader and you decide, okay, I'm just going to hit sell on my entire book right here, right now, and try to actively decide that? But in the heat of the moment, you only have a minute to decide on that. So you need to understand the time horizon you're operating on before those big events take place. And you guys both do a great job of really making sure people understand that, which I think is important. If you've been around Bitcoin for long enough, you've heard the term HODL and the name Ledin. Ledin has been the go-to specialist in Bitcoin lending for over 6 years. Ledin helps you unlock the liquidity of your Bitcoin, allowing you to HODL while still accessing the wealth of your Bitcoin. Ledin has been battle-tested with a focus on transparency, security, and trust. This has allowed them to build a proven track record of client success and security, helping tens of thousands of clients harness the value of their digital assets with confidence and peace of mind. Learn for yourself why so many clients trust Ledin by checking out Ledin's Trustpilot or the reviews on social media. And to learn more about what your Bitcoin can do for you, check out ledin.io. Tokenization isn't just a buzzword. It's the most efficient way to reimagine how financial assets are owned, traded, and managed. Ondo is bringing traditional assets like stocks and bonds on-chain, unlocking trillions in value and creating open global financial markets. They're not just dreaming big, they're building the platforms, assets, and infrastructure to make it happen. Head to ondo.finance, ondo.finance, and see how they're bringing capital markets on-chain. Restrictions apply.
We mostly say it because we forget about it sometimes.
Yeah.
But let's go back to, of course, just doing a quick recap of what happened over the last couple of weeks, the last week, Liberation Day. What was going through your mind? Just walk us through maybe that process, and maybe overlay that with your general cautiousness, nervousness going into the year. Like, what did you observe there, and how did you reposition your thinking around what's going to happen over the next 6-12 months?
Yeah, I mean, so the way I was going into it was, I was already concerned about the US economy in terms of the growth outlook and a complacent Fed, and also a Fed that is already upwards re-rating their inflation forecasts and downward re-rating their growth outlook. So within that context, yeah, we went into Liberation Day, and it seemed like the bull case was if there'd be a 10% flat tariff effective rate. And that's why we saw that jump up initially in markets, because the market thought it was just the bull case coming forth. And their market probably, I would say, priced at 15% effective tariff rate. And then once that sheet came out, obviously it's hard to do the numbers quickly in that moment, but it was very obvious to the market right away that this is way, way, way bigger. And by the end of that day, we got some analysis out that, yeah, the effective tariff rate was around 30% when you do all that. So yeah, as soon as that came out, any longs that I had, I quickly got out of, because this is the one unique and benefit of not running a multi-billion-dollar book is that you can get out in 2 minutes, versus some of these big multi-strat pod shops and stuff. It takes a few days for them. So you can, if it's clear to you what's happening, which it was to me, I was able to get out really quickly and dodge most of that, and basically wait for the multi-strat pods to unwind their books and for the margin calls to hit. And it's really interesting going through the motions of those days, and since is the cross correlations between different asset classes have been really interesting. So basically, leading up until that Thursday of Liberation Day, you were seeing bonds rally, US dollar down, equities down. So this more classic flight to safety. And then Friday and Monday, we started to see US dollar rally, and pretty much every asset class start to sell off. So we saw gold sell off at the same time as US equities, for example, as like rest of world equities like Europe, which was outperforming the US quite significantly going into that. So suddenly you started to see the margin calls get hit, and then you saw the classic flight to safety into the US dollar. So that was where you could tell that, okay, these multi-strat pods are degrossing, they're getting out, they're hitting their risk limits. And so you can just wait for that. And then by, Friday evening, Quinn and I were on a roundup with Tony Greer and Jared Dillian. We kind of talked about how, okay, this is the time where you got to, at the very least, close out your shorts, start to think about some longs. This is part of that capitulation. It's the pod shop capitulation. So that starts to create irrational prices to get into. And then it's been really interesting the last few days since is that we've seen this reversal into what is actually capital leaving the US. So Jim Bianco posted an interesting chart an hour ago, just looking at, we've seen the bond market sell off really significantly, and the Dixie, it's at $100 right now and testing a pretty key level. It's been, pretty much crashing at this point. So that's capital leaving the US. And I'm sure we can get into some of the dynamics of why we think that's happening and contrast that to tariff. But yeah, Quinn, maybe you can add any color there.
Quinn, one thing I'm especially curious about to get your take on is I've been listening to Forward Guidance the last couple of weeks, and one thing I keep hearing you say is, look, guys, this isn't a surprise if you've been listening to Bessent. And even I think it was either today's roundup or last week's, you were mentioning, you're like, look, if you even just paid attention to COVID, and the mindset coming out of COVID was, look, we're all overexposed to kind of like this globalized nature of trade here. Just following up on what Felix said, but also like under this light of Bessent's been signaling this, I think, in your take.
Yeah. It's the classic, like, no one wants to actually do the work to
go listen to Bessent doing all of his interviews.
Yeah. Like everyone's like, what are you talking about? Okay. If you just read the headlines of a snippet of someone's interview here and there, or what, CNBC or whatever puts together as the summary, you're not going to glean the root sort of strategy and what they're trying to do, but it's you just got to read between the lines. But yeah, I think it's been pretty clear from their direction as to what they're trying to do. And I think there was this sort of like everyone was sort of looking past the actual ramifications. It's not that Trump and team wants to crash the markets in any stretch. No president, no person ever wants to reside over that. But it's that they were willing to take the medicine and endure pain in risk asset markets to achieve what they deem to be more important long-term sustainability goals of balancing the budget, which is growth negative because we're spending less, of reshoring trade, key national security and critical infrastructure, trade components from China, and this actual sort of bringing forward of the potential threat that lies out there that no one really wants to address and was never addressed in the last number of years, which is China maybe making a move on Taiwan. So I think it's disruptive. It's definitely was a very boisterous week in terms of communication and how they went about implementing and how they went about trying to negotiate and bring partners to the table and affect their goals. But if you put that all in the context of actually how massive these changes are that they want to get through, you kind of have to swing pretty big and ruffle some feathers in order to do that. So that was kind of and as Felix mentioned, pricing in the markets and investing and trading it's a combination of what the market believes, what you believe, and what's priced in, and then what's actually right. And you have to triangulate what's priced in with what you think, where you think consensus is, and then where your view sits in the middle. And, we were just priced to perfection. And all these signals and communications pointed to a lot of bumps in the road. It's not that we need to tip into recession, but a lot of byproducts of these policy changes in the near term are growth negative that increase those chances.
I think a lot of it comes down to like your investment horizon, as both of you guys were saying. Can you you talk about in investing like this expected value? There's multiple scenarios as we go from here, right? And can we just entertain the most bearish scenario? Call it in the 12 months. I think a lot of our audience, just generally, the market is like very.
Let's talk rest of year, like probabilities for what happens the rest of 25.
Year, let's entertain. Spend this chapter of the pod like talking about most bearish case, middle case, most bullish case, and then overlay that what you think, and then what again the meta, what the rest of the market, Jamie Dimons of the world, hedge funds, and foreign investors think. I know it's a difficult exercise, but let's just spend a moment on that.
I think the most so the most positive to me would be this lockstep, stair step approach to affecting the growth negative, but sort of long-term sustainability viewed initiatives like reducing the budget deficit, which when the government spend less, that's just bad for stock prices and GDP growth. That's just the equation. So they need to slowly bring that down over a year or two, and that will help calm the bond market. That will help, lower the cost that the U.S. has to pay to finance their debt, because people will be less concerned about fiscal sustainability. They need to do that in kind of conjunction with some of these positive pro-growth tax extensions from their previous bills, and then the deregulation initiatives, which they've already started on the energy front, cutting deals with the Saudis and opening up additional drilling and sources of energy, which helps anchor inflation, bring inflation down to offset any near-term impact of tariffs that might be inflationary, because you reduce the input costs, and do this in a balanced way throughout the remainder of the year. I would say the most bearish is one where they feel too pressured because of maybe midterms in 26, or that would be the date, really, midterms 26, where they say we need to tear the Band-Aid off and tear it off quickly, because not only does it become a threat to our long-term initiatives if this is running into and around midterms in 26, but the longer this goes, the more likely there's problems either in actually achieving what we want and or cutting into the economy deeper and a worse recession or growth outcomes. And so if they have that view, they might want to really, cut once deep type of thing now, and be more willing. I think Trump showed he was more willing to eat pain than anyone, even myself, who expected this sort of scenario to be. And they really want to put these things through and really backload all the tax and pro-growth, pro-markets things into the later part of the year. So I think that's most bearish. The problem there is you really hurt receipts, you hurt growth, you hurt the labor market, and you almost tip us too far negative growth that you have to then respond with bigger stimulus, worsens inflation, et cetera. So the most optimal outcome is really long-term for asset prices to be pretty range bound and choppy this year, not blasting to new highs where inflation's an issue, or, cratering where recession is a scare, but just sort of maneuvering it in a responsible way. But I call it the controlled burn efforts, with the risk being that controlled burns can become uncontrolled, and then you have to do things you didn't want to do.
Yeah, Felix, before we go to you, maybe I just want to entertain Quinn. I didn't hear any about the geopolitical risk of like just China, Taiwan. That could really just derail. I mean, just for
Yeah.
context, Taiwan produces 60% of all the chips in the world, 90+% of all the very specialized chips. There's a facility in North Carolina that actually like produces high purity quartz, which is actually the choke point of the world. But Taiwan is, for all intents and purposes, like. But geopolitical, I don't know if you didn't talk about it. You or Felix want to talk about it.
The reason that he needs, or their belief is that they need to get the Western world all together, is if they want to go after either the decoupling or confrontation against China in some form or another, they need everybody on board for this. Because look, we're at 150% tariffs on China now. When we get to those levels, we start to see diminishing levels in terms of the calculus for rerouting shipping. Regardless of where we're at now, we're already at the calculus where, that trade is going to be rerouted through Vietnam to avoid those tariffs. So it's not a coincidence that if they want to get all on board on isolating China and actually having these 100+% tariffs actually be meaningful, they can't just reroute through the other countries. So they need every other country aligned there. So if that happens while we get marginally lowered net, trade impact, let's call it, for these Western countries. And then they all focus on getting this deal done with China that could potentially lead to, these lowering of tariffs of 150%. I think that provides a really good off ramp for this whole situation, and hopefully we can recalibrate the global, economic trade order within those realms. And that's, I see, the key goal. So the issue is getting to that point without people losing faith in the US bond market and US capital as a whole. And that's where we're starting to see some testing of that right now. So I've been really focused on the bond market this week for the last few days, because what we've seen is that there's a lot of leverage built up in U.S. Treasuries. We have, something called the basis trade that hedge funds put on, where they buy Treasuries and then short the futures and collect the spread, similar to Athena for crypto natives. This is the original Athena, and hedge funds lever that up like an insane amount. And then there's also some more idiosyncratic and more technical trades too, and around like swap spreads, but similar ideas. So the idea is there's a ton of leverage within the U.S. Treasury system, and then as we start to see this question of, there's a lot of people coming out with these, I'm still going to call it a conspiracy that China is just, selling all their bonds onto the open market right now. These cross currents are effectively creating a lot of volatility in the bond market. And during this dynamic, if they start to see the long end really start to question, the faith in this trajectory that is the bull case I just panned out, you can get to a point where the comparison that's being brought forth right now is what happened in England a couple of years ago with Liz Truss, where they brought in some fiscal concerns, huge deficits, and that caused the bond market to basically go on strike, to the point where the Bank of England had to step in and do temporary quantitative easing overnight. So the risk is that this accelerates further down that path and they lose the bond market, because this goes against the entire goal of Scott Bessent, which is he says focus on the 10-year. We want to get the yield of the 10-year lower. So you have to basically try to toe this line of getting to that endpoint of these negotiations and squaring in on China without losing the bond market. And it's a tough one, I'll be honest.
Felix, what's the or Quinn? So I mean, like, if you look at what's happened since Trump got elected, right? I mean, the 10 years has fallen from 4.8 down to 4, and everyone's all happy about this. Why have we spiked up so much? This feels counterintuitive to me. What's the reason for this?
So that's where I think like 70% of it is this leverage blow up. So we talked about the pot shops blowing up. There's also this basis trade that's been unwound, and then there's the speculation of our foreign central banks also selling their treasuries out of some sort of protest or escalation of the trade war. I discount that idea quite a bit, but I think for the most part it's been leveraged. But it's just about oftentimes these things have a technical catalyst that leads to a fundamental acceleration. So it's trying to figure out where are we at within that. If you've been around Bitcoin for long enough, you've heard the term HODL and the name Ledin. Ledin has been the go-to specialist in Bitcoin lending for over 6 years. Ledin helps you unlock the liquidity of your Bitcoin, allowing you to HODL while still accessing the wealth of your Bitcoin. Ledin has been battle-tested with a focus on transparency, security, and trust. This has allowed them to build a proven track record of client success and security, helping tens of thousands of clients harness the value of their digital assets with confidence and peace of mind. Learn for yourself why so many clients trust Ledin by checking out Ledin's Trustpilot or the reviews on social media. And to learn more about what your Bitcoin can do for you, check out ledin.io. Tokenization isn't just a buzzword. It's the most efficient way to reimagine how financial assets are owned, traded, and managed. Ondo is bringing traditional assets like stocks and bonds on-chain, unlocking trillions in value and creating open global financial markets. They're not just dreaming big, they're building the platforms, assets, and infrastructure to make it happen. Head to ondo.finance, ondo.finance, and see how they're bringing capital markets on-chain. Restrictions apply.
How much of it is, look, we're not political experts. It's hard to read, especially someone like Trump, which just sort of like goes counter to all like diplomatic handbooks that you might get in any policy school. Art of the deal is not in like, the United Nations handbook, so to speak. But it is something that like I think about a lot, which is thinking about like extreme scenarios and having cash available, like what Buffett has done. I mean, like, you always want to make sure that you like insulate yourself from what could kill you, like sort of Talib Turkey. In a scenario where like this escalates, Taiwan, like I just want to like my appreciation. I read Chip War and then a couple of books that talk about this, but like to put it in perspective, COVID is a minor episode. This would halt all assembly lines. Everything relies on a chip, and it's just like it would halt everything for hospitals, airplanes, cars, smartphones. Like everything just comes to a halt. Inflation shoots up
Wrecked.
dramatically. You're just
Wrecked.
basically wrecked. The market, forget about any bearish scenario in your book, probability weighted. This is like extreme tail scenario. So what do? Like you invert, you pull it forward now and say, okay, how much cash do I actually want to have? Because volatility, I hear you, is going to continue to persist. So how do you express that view, and how comfortable? I guess the direct question is how much cash do you have in your portfolio, and how much are you willing to just hold, and for this type of like extreme outcomes.
Let me give you an example of when I say Bessent, listen to Bessent, and everyone says you're crazy. Like Trump doesn't listen to him. Remember the line a week ago when he said, "This is not a MAGA problem. This is a Meg 7 problem." And everyone's like, "How could he say that?" He's like cheering on, our largest companies' stock prices going down. No, what he's doing is if China invaded Taiwan and we were running into that situation with what we had earlier this year, where 40% of the S&P 500 was in Mag 7, the S&P 500, Nvidia would be down 60% the next day. The S&P 500 would be down 30% in a day. And everybody would be looking around because they all piled into this stuff at Pico top saying, what Fed, Treasury, what are you guys going to do to bail me out? Well, you just bought these like crazy expensive, overvalued, overpositioned companies ahead of like this massive event. He's actually by putting this message into the market, he's saying, hey, think about this. Like, there's a problem here that we're over reliant. Our stock price, our indices reflect that. So for me, it's a positioning for your longs as to things that benefit. You could think about defense. You could think about commodities and energy and key minerals or key resources. You could think about mission critical industrial manufacturers that in the worst case scenario, okay, this year a war might put us in a recession and we need less widgets, but we still need widgets. So I think it's thinking more about, because you're never going to be able to predict that. It's almost the Buffett approach. I mean, he's got to raise this cash very slowly because he's moving such size. But if you look at his portfolio aside from that, he's leaving the Apples, he's going into the Oxys, like he's rejiggering his underlying sector exposure to try and account for some of that risk, knowing he's never going to get it right.
So the big question at hand for me now, especially as we see the bond market, start to accelerate, is we're all asking, when does the Fed step in on this and provide us the off ramp for quantitative easing and all our bags go up? And one of the big questions at hand right now is, the bond market selling off, like 30-year yields increasing is not exactly, it's more of a political decision than like a financial stability decision until it starts to affect liquidity. So when we talk about treasury market liquidity, the big distinction is, for those that are in the weeds on bonds, there's on the run bonds and off the run bonds. Off the run bonds are all bonds that have not been issued in the most recent issuance. The on the runs are the ones that are the most liquid. So oftentimes, like in March 2020, what we saw is that the off the run market seized up. There was no bids, no asks, there was no activity whatsoever. The treasury market froze. This is a big reason why we've seen, we've heard about the Treasury doing Treasury buybacks now. They're buying back those off the runs and doing that on a neutral basis because they are also issuing on the runs at the same time, and that balances out, but the liquidity improves. So the 30-year increasing is not too concerning for the Fed until the liquidity starts to seize up. So how do we measure this liquidity? Because everybody thinks the Fed just looks at equities, and when it goes down 15%, they step in, but they don't actually really care about equities. They care about these very important parts of the plumbing market. So I'll just bring up my screen. This is one, here's some alpha for the Empire crew, but here's a couple indicators that the Fed actually looks at and cares about. So this first one is SOFR to IORB. So what this is the secured overnight funding rate, so netted out by the interest on reserve balances. So for those that aren't in the the deep world of monetary plumbing, there's basically bands of different facilities and offerings that the Fed does to keep the Fed funds rate within the band that it actually wants for monetary policy. And when the SOFR, so the top of that band is IORB, which is basically the interest they pay on bank reserves to banks, and that sits up there. And so SOFR is the floating rate of the Fed funds, and as it gets higher and closer and potentially above interest on reserve balances, what that shows is strain in the funding markets, which is the most important thing in the world for the Fed. This is it, it's on them to keep this functioning. So what we saw this week is that we got above zero for the first time outside of quarter end date. So you can see there's a few times here in the last quarters where it was above that, but that always happens at the end of like these this is very directly related to quantitative tightening. As we get to the end of this whole phase, you start to see this at the end of quarters. Now, what's interesting is this week, it's the first time where you can see we got above zero, not at one of those quarter end dates. So this is, we've seen it come off a little bit yesterday. This is lagging data. I don't have a fancy Bloomberg terminal where I can see this live, but effectively we've seen that strain start to show up. So if we start to see that, if we start to see, those off the runs trade with terrible spreads, these are actually the things that the Fed starts to care about. Or, for example, I have the high yield credit spreads. So this is also another important thing. So you can see, we've increased quite a bit, but we're still, where we're at in terms of, a lot of like the duration crisis of 2022 is what I call it, where inflation just destroyed bonds. But if this, if high yield credit spreads start to accelerate further, these are the type of dynamics that the Fed actually looks at. And that's what I'm looking at to gauge whether they step in or not. So as of right now, it's mostly a political decision of if they want to step in and cap the long bond. But as of right now, there's some, funding fractures, but it's still operating. So it's this weird moment where we either need things to fall apart further or for things to improve. But yeah, it's a weird one. But that's how I'm thinking about gauging when the Fed actually steps in.
Yeah. But before recording the pod, we were talking about Jamie Dimon and his comments. You, Quinn, talk about Bessent a lot. Who else do you pay attention to? Is it Jamie Dimon? Is it, there are a lot of people coming out and, having an opinion on this stuff.
Yeah, I think there's a lot of, Twitter's awesome because there's just so many smart people who, maybe they worked at a big bank, maybe they worked, different places and got sick of the bureaucracy and just take their talents to Substack or other. So there's a lot of good people on there. Like Andy Constant is good at this plumbing stuff, Joseph Wang, and I think Warren Pies and some people like that. So for me, we get bank research and all of that, but a lot of it, that's good for the data and kind of numbers. But in terms of like interesting opinions, I'm usually, kind of scrolling Twitter sometimes to get alternate views. When it comes to policy, I think Bessent, kind of forget everything else. Hassett, who's on his team, is also really high quality and pretty transparent. Jamie Dimon, like him, there's people like Chamath and others, Ackman, who you might even listen to for contras, where once they start getting into something, it's time to look the other direction. Because for Dimon, right, like this is very similar dynamics to the March banking crisis in 2023. So to rewind the clock there, what was happening was a bit of an inflation scare that was sending long bond yields higher and stock prices lower in conjunction. And it got so bad that all of these banks who had been sitting on large piles of treasuries they bought in much lower rate environments, higher bond price environments, their balance sheets were deteriorating in value rapidly. And so there's nobody worse off than the banking system, the US banking system, when bond yields are doing what they're doing. And that's actually probably part of the reason you're seeing Bitcoin trade so well right now, and gold for sure, because gold can trade even better when shit's hitting the fan. But it's because it's becoming apparent that before S&P hits 4,500 or some other crazy risk off things occur, it's apparent that the bond market and yields are going to rip to a point that's unsustainable for a healthy banking system, and the Fed will likely have to act. So it's tough. You got to just take a bunch of opinions. Diamond is usually talking his book, but it's a data point. It's a signal you should be aware of.
Quinn, talking about Chamath for a second. So Chamath's, when all this was happening, Chamath was like, look, you guys don't get it. The goal is to bring the interest rate for Main Street down. We're trying to bring the treasury down. And now the treasury is obviously going up, went from like 4 to 4, I think it's 4.5 or something right now. If you had to summarize, I don't know if Felix and Quinn, if you guys agree actually on this, but if you had to define the main objective of tariffs, I'm hearing two different takes here. Actually, one is we want to. It's like it is kind of the Chamath take. It's like we want to reduce the 10-year, get interest rates lower, both maybe at the short end and the long end. Maybe basically just reduce interest rates. The other side of this is we're redoing global trade, and what we're doing here, Felix, I think you talked about this on the 1000X pod. We're trying to align the Western countries against China. If you had to pick one of those as like the main objective of these tariffs, which camp would you fall in?
For tariffs, it's the latter because tariffs are hurting, as evidenced by the bond market, their goals of bringing yields down. For me, going into this year, actually, setting aside the conducting of their messaging around tariffs ranked like third on my list of things I was concerned about for risk assets. So I misjudged even how poorly the market was going to receive tariffs. Granted, some of that was due to the manner in which they were delivered, but getting the bond yield down is more correlated to Doge and the deficit reduction, which when a country's spending way more than they can afford to spend, they have to issue way more debt than they should be, diluting the amount of treasuries in the market and increasing the price they have to issue at to the next marginal buyer. So their core focus is the deficit, the budget deficit, not trade deficit, and that is what they need to get that down in order to bring yields down sustainably. Tariffs is actually sort of hurts that effort in the near term because it is slightly inflationary, many say.
Yeah.
But it's more strategic, I think, on the tariff side.
Yeah, I think the Chamath view that tariffs' goal was to decrease the 10-year was just a convenient coincidence for him. I don't think it was really. I view those as separate goals, and I think it made him look pretty dumb because he doubled down on that idea that tariffs were the causal factor of the 10-year going down. It was just more so the pricing and concern of a recession, and then that quickly got reverted by leverage blowouts, et cetera. But yeah, I view them very differently. I'm more in Quinn's camp that there's different policies focused on lowering the 10 years. So obviously the goal of decreasing deficits is one. And I probably fade Doge a little bit more than Quinn on that regard in terms of the effectiveness of it. But overall, I think that is where the goal is to lower deficits. It's to deregulate. This is probably the one that I will over-index in terms of the potential for it. I think there's a lot of bank deregulation that's going to come down the pike over the next year or so, and that's going to help banks to buy up more treasuries, and it's going to help with collateral ratios, et cetera. So I think that is going to be a very significant factor in lowering the 10-year. And maybe a couple years down the line, if on net we end up with lower tariffs than when we started with this whole thing, that would also lead to more effective and more efficient growth for the world. And generally speaking, when you have productivity led economic growth, so positive real GDP, not inflationary growth. To Quinn's point, like just listen to Scott Bessent, he said this many times. We want non-inflationary growth, which is basically saying we want productivity led growth. Yeah. What's one of the best ways to get productivity led growth? Unleash capitalism, unleash deregulation. So
AI.
Yeah, and AI, yeah, exactly. Just letting it rip, and this is where AI comes in, where crypto comes in, and just the efficiencies of like stable coins, for example, too. When you have instant global settlement for the whole world, like that does wonders too. So I think it's more about reordering global trade around China, and getting everybody's ducks in a row. And then there's also the revenue thing. I think the 10% is just going to be permanent to some degree. And I think they're trying to use that to fund further tax cuts, which is an interesting proposition. But yeah, part of it is also the revenue idea.
Yeah. Well, hopefully we don't poke a bear too much, where we go into full
Yeah.
out war and chip
Yeah, exactly.
freezing. I want to transition this next chapter into what I came here to learn is, should I be punting Bitcoin and all alts right now? Should I be holding cash, or what the hell should I be doing, gents? Because, of course, like you see people come out of the woodwork on Friday and say, look at Bitcoin, it's holding up exceptionally well. And my reaction was just like, for now. And then, of course, it's still a risk asset. And I'm kind of curious, as you package all the stuff that we've talked about throughout this pod, what's your current thinking around crypto and your appetite, your term horizon? What are things that you like? What are things that you don't like? Kind of curious.
For me, I believe we are, for the remainder of the year, going to be in a elevated volatility regime relative to the past number of years, meaning the VIX is not going to settle back in at 12, and it probably settles back in the high teens or at 20 or something. But that is still a meaningful decrease in volatility from the recent weeks. And that on Friday, there was a lot of hoopla made around that, the potential for decoupling between Bitcoin and US equities. But there is actually a kernel of truth in that if you look at how they've been trading over sort of like a multi-week horizon. And I think a lot of that has to do with gold strength, because I do believe Bitcoin is sort of a 50-50 NASDAQ gold-ish combo of it doesn't do so well in the midst of the mayhem as gold does, but it doesn't. But it runs the fastest when the mayhem is solved and liquidity is provided to smooth things over. So for me, after coming into the year, I put a tweet out saying there's a very good chance that Bitcoin has topped for 12 months. Seeing how things have played out and developed in the way they have, I'm actually more bullish on Bitcoin than I have been since probably pre-election, probably since October. So whether that's a trade back to 93 to 100, or that's new all-time highs, let's see. We got some ground to chop before needing to make that decision. But there is a very strong case to be made here that the powers that be are going to have to step into these markets and fix something. And if you believe that, or have a view as to what the future looks like, it's probably more beneficial in most cases for Bitcoin than it is stocks earnings, let's say. So
Quinn, if you think Bitcoin's going to hit an all-time high this year, how do you think about pushing out on the risk spectrum? Are you like, oh, Bitcoin, okay, like maybe I'll go into Sol, or maybe I'll push into Hype? Like, do you start looking at other crypto assets, or it's just you're not there yet?
I think I'm sort of in the fundamentalist camp. I obviously know that crypto does not trade on fundamentals, in short-term horizons, but I do think there's a long-term gradual shift towards that. Because for me, a lot of these things, when they're compared to other valuations of things you can buy, are still very overvalued, relatively speaking. So, one of the big things you learn, and it's a macro people talk about, is like when you have a view, you might be right, but a lot of times people get the expression wrong, because they're saying, oh, I think rates are going to fall, I'm going to like lever up on home builders because I think if rates fall, housing activity is going to boom and home builders are going to rip. And it's like, this is a case where, am I bullish volatility maintaining at high levels? Yes. Am I bullish on Fed and Treasury having to step in to provide liquidity and support markets? Yes. And am I bullish on the dollar weakening as the structural decline? Yes. And then you say, okay, well, that's Bitcoin and digital gold. And yes, there's bouts that alts do really well. But I think if you maintain that 2021 mindset of like, oh, we're in a bullish environment for Bitcoin, just sprint to the furthest out the curve thing, you're going to run into what we've had. I continue to believe Bitcoin dominance just goes up and up and up. So for me, I almost think in a lot of these cases, your risk reward like is almost better. People want alts for leverage Bitcoin a lot. You almost might be better off if you look at the stats and run the ratios of risk, like levering your Bitcoin. I'm not advocating for that, but I'm just saying in terms of creating a volatility or beta adjusted position, a lot of these alts have proven to have much more downside with maybe
Yeah.
similar or slightly more upside. So for me, I'm trying to stay true to what my view is. And yes, there's assets in crypto, alts, and crypto equities that we think have gotten to levels that are interesting, but it's definitely not a like throw the dart at the dartboard on the
Yeah.
ticker sheet thing.
Felix,
Yeah.
before we go to you, on this point of expressing the view, we were talking about this on the pod, the roundup yesterday, which is there are now more vehicles and mechanisms to express this view for crypto. You're going to have more IPOs, presumably, maybe not, but like you have the ETF, you have Hood, like Robinhood, that is getting more into crypto and might trade on that. There is Coinbase. Going back to this nebulous risk-adjusted way to express a view, levered Bitcoin versus alts, and maybe you buy Robinhood or Coinbase, you can, maybe more tax efficient ways. Felix, maybe you want to overlay that thinking into how you would express your view in crypto going forward.
Yeah, I'll tie that up in the second half of my answer. But the first half here is that, yeah, I'm bullish Bitcoin and crypto on a mean reversion basis. But for an explosion past all-time highs on, let's focus on Bitcoin, because I do think, our asset class is getting old enough where I think it's worth start piecing those apart separately. So for Bitcoin and what its correlations are relevant to, any further upside past all-time high is, to me, actually a bet on the failure of Trump and Bessent policy. So it's a bet on increased fiscal deficits as opposed to reining them in. It's a bet on them losing the bond market and the Fed coming in and doing quantitative easing in some form or another. It's a bet on, this third one is a bit more difficult because it's a bet on recession, but obviously it's going to go lower first, and then the Fed comes in full force. So I think really meaningful upside in Bitcoin is, and also just like, yeah, losing the lack of faith of the bond market and the US dollar as a whole as well. Like, these are factors that Bitcoin was born for. So it's almost, for the meaningful upside, it's almost a bet on a lot of those, which is interesting one, because it's also, President Trump is crypto president and he's super constructive about it. And this is where I get to the point of separating these asset classes, because I think regardless, there's also the technological innovation that's happening within, stable coins. I'm insanely excited about. I think it's one of the most interesting things in decades. So I think those components, and also, Robinhood and et cetera, coming in as well. This more the technology side of things, of the innovation, not the hedge against, reserve currency type stuff, is, I think, going to do well regardless, because you have the deregulation, you have the promotion of stablecoins and the uplifting of it by this administration. So I think regardless, that stuff does well. But for like all out Bitcoin dominance, outperformance, it's actually a bet on the other side of things.
I look, as far as I can remember being this asset class, people have talked about Bitcoin being hedge against macro and irresponsible fiscal policy and all this jazz. But time and time again, as we look through and we lick our wounds every cycle, we say it was all an M2 trade. And so Bitcoin will continue to be a risk asset. And I hear you on, it is like a small, treat it, maybe it's a sizing thing. It's like, treat it as a very maybe cheap insurance policy in case, it's an escape hatch to all this shit blowing up. And maybe Bitcoin at that point shoots up to a crazy amount. So you want to have it in your portfolio, get off of one, get off of zero. It's more of the go back to how much cash you have relative to Bitcoin. I think for me is more of a question that I've thought about more and more, which is, I want to hedge macro. I'm not a macro guy, but I do want to have. I've always felt that you factor in two things that we've talked about in this pod. One is what is being priced in. If it's if the S&P is at 23 times all-time high, the expectations are high. There's going to be some mean reversion. That's just how markets work. The pendulum will swing back. The Howard Marks of the world kind of, I ascribe to that thesis. The other part of my brain says what gets us out of any rut is continued technological innovation. So go really long over a longer period of time. So like over a 5-10 year period, I want to be long stuff that I think gets us out of all this shit, which is AI and crypto and maybe some biotech stuff that I really like. So I have a portfolio that is centered around that. But I am mindful of these dynamics that are constantly evolving in real time. And the part of my portfolio that is a bit more short term and a little bit more backing and solving for my psychological state, where if this stuff really happens, I want to be in a position where I want to step in and have cash. It's never hurt to have cash in crypto or just generally. And if you Quinn, I agree with you, like long vol. So like I factor all that. So I guess the question that I'm trying to get at is how do you compute all that? And I guess the ratio of how much Bitcoin you want to have relative to just cash, or maybe other like industrials, rare earth mineral stocks, like shit like that.
Yeah. The problem with cash right now is, well, depending where you're at, if for me, I'm in the US and the Dixie just went from 107 to 99 or 100. So I just lost 7% of my global purchasing power. Gonna have to pay up for those Aperol spritzes this year over in the Med, but like
I'll sponsor Quinn. But how much are you buying? Are you gonna buy
yeah,
like these equities? Or are you gonna buy like most of like I guess where is growth gonna come? Are you gonna
I
go
think
buy stuff? I think Europe is dead as content.
yeah, it's I think mission critical industry and resources, like an example is looking at the things that, okay, we just, like in all these things, there's opportunity. Everyone wants to talk about, oh my God, we just cut ties with China and it's a bad thing. Well, it's like, well, why don't instead of talking about that, you spend the next week digging into every single industry sector and company that we relied on China for that now needs to be done here, Mexico and Canada, and understand where huge opportunity is. I think oil and energy and natural resources is going to be a very interesting place. We've obviously got smoked recently as some supplies come out of the market and growth expectations have gotten hit. But I think, in times of war or geopolitical conflict, that's a pretty, defensive position. And you can also look at pairs in terms of longing something and shorting something that gives you maybe is more exposed to it. But it's kind of for the funds, it depends on your strategy. We will move in and out of things within weeks. So we're happy to go 100% long Bitcoin for a couple of weeks and be out if our objectives are met or were invalidated. But in terms of like a long-term investor, yeah, I think it is prudent to probably not at these levels after the big mess, but on dips, raising cash and just being ready, because it's easy to forget after two back-to-back record 20+% S&P return years and 100+% Bitcoin return years. It's easy to forget that things can get cheap and stay cheap, and it will feel like, oh, this is a great buying opportunity, and then it's like the dippity dip, and it's like, yeah. So people just remember that can happen, and things can get worse before they can get better. And be thinking with that long term. So I think it's kind of one where if you have the ability to actively manage and raise a little cash when things rip up, sell a little when, and then deploy a little when they go down. I expect a big range bound market, to be honest. Like I expect like S&P range bound for like multiple years, maybe, type of thing.
So Felix, I give you $100. How much of Bitcoin, gold, cash, defensive, and Max 7 like innovation kumbaya are you buying?
I'm gonna do $30 gold, $20 equity.
SPX.
Yeah, just index, and then the remaining 50%.
SPX 6900, right?
Yes. So that covers gold and equity beta, and then the remaining 50% is I'll put another 20% into Bitcoin, so that gets me to 70. Then the remaining 30% is what I call, and I think this is what you guys represent so well, is the high beta technological optimist trade. And I think that's what you guys both do so well. And I think that aligns really, like, if you want to, that's the one that really gets me most excited. The other stuff is just cross correlation hedging, basically, in terms of like, sometimes gold does its thing while Bitcoin doesn't. They trade differently during different regimes, but then also kind of have this confluence thing. So yeah, the 30% one, that's the one where like fundamentally I'm the most excited about, because it ties in nicely to what we talked about earlier in terms of like, the Scott Bessent goal of let's get non-inflationary growth, real productivity-led growth. That's that technologist optimist trade, and I think that's the most powerful one that has the most upside. But again, it's highly volatile, it's high beta. It ties into this what you're saying earlier about, do you just, sit in Bitcoin because it's lower beta versus the alts, or do you just go into the alts but lower your position size? And how do you manage the vol versus the fundamental catalysts? And so, yeah, I think you have to size it effectively, but I do think there is some meaningful upside to the optimist trade, as opposed to the buy Bitcoin because of the failure of the US dollar trade.
That's interesting. Quinn, I don't know if you want to respond in this allocation game, but I find it interesting that you took 30 gold, 20 Bitcoin. So you're more perhaps your outlook. If I read into that, I'm like you're perhaps a little bit more cautious about the rest of the year.
Yeah, it's just a beta thing. It's just the volatility. Like you can, gold has a lower
Yeah,
beta, so you can size it bigger.
yeah.
That's really it.
And something you mentioned is the name
Why,
of the
why,
game.
why Felix? What do you mean by that? That you can size it bigger? Is that because you're not comfortable taking on volatility? Like you don't want something to go down that much because you're playing a short. Like if you're playing a longer term game, like you talk about these time horizons. If you're playing a longer term game, the volatility doesn't matter at all, actually.
That's
So
true. Yeah. I mean, that's where like I sort of end up deferring to like the traditional portfolio management theory stuff where
yeah.
it's just like I want to size up my bets versus the expected volatility of it. And
Hmm.
what I respect about crypto natives is they don't give a shit about that. And it's just like, let me embrace the volatility and just like go all at it. And I respect the hell out of that.
Look, it's
But
backfired several times. I'll say
What,
that. So
what, what about like structured products and that? Like, of course, like the expression of all these things. Like, if you're gonna, I found them to be an interesting pocket to like. If you go long vol, you could at moments where the market's puking or whatever, you can clip some really interesting coupons and
Mhm.
reinvest that cash flow into way higher beta stuff. Like that for me, as I think about like how I've managed my portfolio over the years, is like I want to have uncorrelated cash flow producing assets that I can then pile into the giga, like, all right, I'm going to invest in the seed round for a project that might be 100x or bust kind of thing.
Yeah, man. I mean, long vol is the golden goose of portfolios, right? Because for the most part, we're all short vol, and the hard part is how do you get long vol without it just dragging on your portfolio? Like, there's no free lunch in finance. So either you just you just buy out of money puts and just roll those every year or whatever, and that's just the cost of doing business for those terrorist hedges, or you try to do something fancy like the long vol funds do, where they try to basically get like a positive carry on a long vol hedge, which is also the golden goose of finance. And that's like what Nassim Taleb always talks about. Like that's his whole idea. It's difficult. I think like you can't just buy VIX calls and just sit on those, and just wait to cash them out, because markets are smart and the options will price those effectively. So it's the idea is good, but the execution of it is awful. Maybe Quinn has a cooler idea though around it.
Yeah, there's no replacement for cash when you go to the when you wake up and the market's down 5% and you're in cash. You're not wondering if that's going to get hit too. I mean, when the dollar's down relative, but I think I don't like sovereign bonds of any country because I think the cost of capital globally rises when you have this decoupling and multipolar world regime. So I look to other income sources. One could be like there's a ETF. Uh, I don't own it right now, but it's an example of AMLP, which is energy focused. It's an MLP. You can look it up, but high dividend, fairly stable as long as obviously oil prices don't go to zero. Cash flows tied to what I would consider a mission critical good and infrastructure being, oil and gas. So there's those things. There's also high dividend equities that there's lower volatility equities. So there's, to your question, Jason, around like the gold versus Bitcoin split, it's part of that answer is also to do with how close do you think we are to the end of this mayhem than the beginning? Because part
yeah,
of solving for lower volatility is just saying, hey, I don't know. I know, but if I think there's higher chance that we do drop big or we don't, because presumably Felix, there might be a time where everyone threw in the towel in Bitcoin. He goes, okay, zero gold, all of it in Bitcoin. So
yeah.
part of that.
Let me get your guys' take on one actually specific stock that Santi and I talk about a lot, which is Coinbase. Quinn, I feel like I used to see you talk a lot about this. I don't know if you're still a holder of Coin or if you just had a nice little run there. But so there's this Jeff Dorman tweet. He said, I honestly don't know how Coin survives. Robinhood and bulge brackets are going to win the trading biz. Custody has no moat. Stablecoin interest income going to zero. Their customers hate them. Parentheses, look at the comments. Acquisitions have been flops. Management makes baffling decisions like buying back 0% debt. Quinn, are you do you remain a Coinbase bull, or did you get out of that trade?
Yeah, I haven't. I've been on the other side of that trade more in the last 3 months than I have long it. They've what's really good for everybody in terms of opening up the regulatory umbrella and support and new people rushing in, traditional finance rushing in. That's a negative for the people who benefited from regulatory capture and being able to charge rip your face off level of fees for years on end without any competition. So you're already seeing it with Robinhood on the retail side. I think you're seeing it with many players on the institutional side. You have traditional prime brokers like StoneX, who are public and large, getting into crypto trading now that it's kind of approved. You're going to have all the big banks. So yeah, I mean, when you look at, they charge like 25% on staking. I mean, staking is about as commoditized of a product as you can have in crypto. They're charging, exorbitant fees on retail trading.
I will
It's
push
tough.
back on that because the stickiness of the staking deposits is something that in finance in general, the stickiness of the depositor base is high, and so I would just that's the only when I hear you say that, I want to run this validator business way back, but I think the thesis there, if I take the alternative, is these can persist higher, unlike like your like your grayscale products, because the stickiness of this base is probably higher. But yeah, I mean they're getting hit hard on a number of
And it
fronts.
also just goes to what is being priced in. And I mean, the
Oh
multiples
yeah,
come down, obviously a ton with prices, but and then also a view, I'm not sure I want to be like super long crypto trading volumes right now either. So yeah,
yeah, yeah.
there's a number of other market
I
more.
like Hood more than Coin, but for a couple other reasons. But I am curious. It's just a more diversified business, but also
Yeah.
just I guess how much of Coin and the trading and the expectation there's been like the MicroStrategy premium, which is there's a scarcity value attached to some of these assets where historically it's been hard to express a view in a more traditional construct, which is, and that was like Coinbase, MicroStrategy, now maybe Hood, maybe Nubank to some capacity. Like public companies have started to get more into crypto, but Coinbase has been like that premier kind of blue chip, call it, of let's go long crypto in a very pure vanilla career risk low way, but as we have more, as we have more options available, the ETF mainly is what I think about. The premium just goes down. The like that demand goes down, so the multiple comes down. Just don't recover.
This is going to end up being a bit of an echo chamber because like one of the biggest things I bought at the lows here in this recent crash was Robinhood, and I finally felt like I got my entry into it, and so I'm definitely on that side of things as well. But yeah, I will say that I'm pretty bearish on just this idea of branding of exchanges. Like you compare it to TradFi, where it's just like you just have your brokerage, and you don't really care about the routing that it goes through. You just care that it gets settled and it's in your brokerage.
No,
Obviously,
but
we
you
live in
care.
a
No, but
different.
you care which brokerage it is. Like you're either a TD Ameritrade user or a Charles Schwab user. Isn't
Yeah,
that branding
On
of
the
an
retail
exchange?
side, on the institutional, you're saying you don't care, and then the fee compression goes down because they can't
Oh,
get
on the
away with it.
institutional side, I see. I
yeah,
see.
yeah, exactly. So, yeah, basically, you're fighting that battle on one side, which is that if you have this branding premium of the likes of Coinbase, etc., that's pretty bearish. So it's more about what extends their runway. I'd mentioned in our pre-chat kind of chat there about this, but I think one of the only saving graces they might have is there's those rumors of them acquiring Deribit, and you know options are such a different beast in terms of the liquidity required to make them effective, just because there's so many strikes, there's so many different expirations, and you know the spreads can just become so wide so easily. So I've been a huge bear on like on-chain options for years, because all of them, like, you just go and look at the spreads and it's just like, as a buyer, I'm not walking that. It's just insane. So obviously Deribit has become the de facto place for all crypto options, and there's some stickiness there in terms of a moat. And I think if they got that, that would differentiate them against other crypto exchanges. But then you're also once again fighting the battle that if you look at like IBET options, those are the tight, like it's going to be really difficult to fight those spreads. They're just always going to be tighter because you have institutional market makers there versus there's a lot of institutions that still can't even touch Deribit. So it's tough.
Yeah. Felix, Quinn, great chat. Anything that you guys want to cover that we haven't so far?
We touched on a lot.
Yeah, we did a pretty good job, I'd say. Yeah.
Good. Well, shout out you guys. You guys have done an awesome job covering just
my prediction
everything.
in this pod might be the most popular so far this year.
Oof. Damn.
That's a top signal for us.
Yeah.
Short Quinn and Felix.
Short macro, long technology optimism. That's what I'm
exactly.
Whoever controls the poly markets, let's spin one up.
Yeah, exactly. Cool. All right, guys. Great pod. Thanks for listening, everyone. We'll see you Friday for the roundup.
See you guys.
Stay safe, guys. Don't get liquidated.